Hi viewers, welcome to the channel. In this week's video we'll be discussing NXT is the code, and the company is NextDC, which is a data center builder and operator. First chart worth looking at is the share price of NXT versus the ASX 200 accumulation over the last 5 years. I guess it's been a pretty good story from the early days. I mean, certainly after you see here, including the pandemic, it's not like the market has shot the lights out, but over the last 5 years, it's up, including dividends, roughly 50%, which is not to be scoffed at. But in the meantime, the NextDC share price has gone through the roof and is up over 400% over the last 5 years. I think it's interesting here to see a period of underperformance, not in line with the market actually, and in 2018, and I think it's almost one of the credits to NextDC management and certainly the CEO Craig Scroggie, who at the time really was taking a lot of criticism because effectively what was causing the sell-off was that the company had built a lot of extra capacity, expecting demand to fill the capacity, and there was a period where they just couldn't sell the space. Ultimately, that though has looked prophetic, and that we're now seeing with the pandemic, which admittedly has accelerated the trend of the move to cloud computing, but there's no doubt that he was right, and that eventually that would be filled, and that demand was always going to be there for the extra capacity that it built. I mean, the next chart, the next slide comes from its recent full year 2020, financial year 2020 results. Shows throughout that period as well the 5-year trend for its revenue on the left here, and its earnings before interest, tax, depreciation, and amortization on the right. Some really great things to look in here. Certainly, the compounded annual growth rate of 28% is incredible, and shows the increased move to cloud computing, and I guess the demand for data center space. You can see as well, which is great, the vast majority of its revenue is recurring, which provides companies like NextDC far more visibility on its future earnings, far more safe business to borrow money against for that reason as well. And not many businesses out there over 5 years that you can see a compound annual growth rate of 28%. And an even better reason why I like this stock, and like this stock absolutely, but like this space even more. These businesses are incredibly scalable businesses. They have high fixed costs, but the moment you get over that hump, the vast majority of new revenue that comes in flows straight through the bottom line, and that is the definition of a great business in my view. So while its revenue has only grown at a 28% compound annual growth rate, its earnings have grown at a 67% compounded rate. And I guess that's going to continue to be the case. It's guided, for obviously more growth this financial year, and I think the likelihood is that you're going to see earnings before interest, tax, depreciation, and amortization grow at a higher rate once again. There will come a point at which that slows down, but I think it's still early in on NextDC's life that dynamic is probably still going to play out for a while. Just another chart just to show as well that not only are they growing customers very quickly at 23% compound annual growth rate, as we saw here, we had a 28% growth in revenue, which actually suggests that not only are they bringing in new customers of 23% per annum, but those existing customers are also increasing their spend. And as you can see, part of that is the number of interconnections are growing well above customer growth as well. Really important as well to look at this, the outlook for FY21. Look, NextDC's kind of exceeded all expectations in the last 6 months or so, which, yeah, absolutely, that's been a huge part of that has been the pandemic. But what we're looking at here as well is a long-term theme that has just been accelerated. Businesses globally still store I should say over 70% of their data locally. So cloud storage is still less than 30% globally. So undoubtedly, in my view, this will be as close to 100% as possible one day down the line. It's cheaper, it's safer, it's far more efficient for businesses to store their data off-site and in the cloud, and it's just a matter of time before all businesses, especially in the middle of a pandemic-induced recession, and looking to save money and cutting costs and what's the best way to become more efficient, these sort of themes become far quicker and quicker and quicker, and I don't really see that changing or slowing like some of the other themes that we've seen resulting from the pandemic have or will. Anyway, it's expecting revenue guidance of 21% on the up 21 to 25% on FY20. Again, a bit to guidance of 20 to 24%, but I expect, as I said earlier, that could be exceeded. Continuing to spend money on expanding capacity, which I think, based on what I said on the 2018 hiccup for the share price, is the right call. The opportunity for NextDC is still in its infancy, and it should continue to spend. And really, I don't think shareholders should be looking for dividends or anything like that. This is the time for the opportunity, and they need to spend as much money as possible. So, I think in summary, this is a theme that I love. I think cloud computing is here to stay, and adoption is just going to continue to accelerate. And I can't find a better exposure on the ASX than NextDC, even though you're paying a high price. I wouldn't be buying it today saying, "Wow, I got a great price," but I would be buying saying I'm getting in relatively early in a wonderful long-term theme. Anyway, thank you very much for viewing. If you found this video useful, don't forget to like and subscribe below, and be sure to leave any comments so we can hear your thoughts as well. Thank you very much.